The key thing in this drill is your understanding of market structure going into a central bank event. What we got prior to the Bank of Canada rate decision was a very strong move higher on the Canadian employment numbers. This then started to price in the possibility of another rate hike, remembering that Bank of Canada is data dependent. So what we've had is around about 150 tick move higher that then consolidates, creating on an hourly chart a head and shoulders pattern. So what this does for you is it allows you to start thinking of trades in terms of what is going to have the greater impact. So what trade are you more inclined to take on, or would be more willing to try and take a trade on? And this, for me, you'd be looking at this and thinking, move to the downside is perhaps a better trade. Reason for this is that you've already had 150 ticks move to the upside. If you get something hawkish or a rate hike, how much further can this go? We looked at previous examples and you got around about a 200 tick move on the hike. With this already beginning to be priced in, how much further are we likely to go on this is the question you've got to ask yourself. However, with this pricing, if you get a move to the downside, there's a lot of positioning that is then easier to come out of the market, causing a much quicker and perhaps more sustained move to the downside. So this structuring idea and this thinking about how the market is set up provides you an opportunity to start categorizing your trades in terms of trades that you would prefer to be taking on versus trades that you do not want to take on. For example, if we had a hike, it would be quite reasonable to think that that first move may well, it's going to be quite substantial, but is a move that's a little bit more fadeable than perhaps no change and slightly more dovish rhetoric. That is a move that is then likely to be less favourable, or less favourable to people trying to hold on to positions, and they're going to start coming out of those positions quicker. You've got areas as well here, and so in your planning you can start thinking about, well, how can you get into a trade here? If you're looking to the downside, you've got that head and shoulders neckline coming in at 78.78, as well as the level at 78.73. So that's going to be your area to be looking for. If you can get in a trade around there for that breakdown, you're then in a nice position to be playing not only fundamental news, but a technical pattern based on the structure of the market. And that's the important thing to be remembering here. To the upside, if we start breaking above 79.02, it then sets you up for a move towards the highs up at 23s, and that you would expect would be where we'd be heading towards on any kind of rate hike. So that's the way the chart's set up. In terms of areas to be targeting to the downside, if we do get that breakdown, the way I'd always look at it is when you get a strong move higher, this leaves points where there's limited trade. So these low volume nodes, areas where the market is then likely to try and find some sort of support. Will people then come in and buy there? That low volume area is created by people buying very quickly through an area, and so the implication is there are buyers in that area when we come back. So these areas come in at 78.50, 25, and then lower down at 77.90. So they're going to be your target areas to the downside. As I say, I've already mentioned those areas to the upside. So move on to that drill, and then there'll be questions coming up as well.
Once the press conference then begins, and you'll see if you look at the annotations where trades are then.
Now this drill is an observational drill. The reason that we've done this is to allow you to actually slow your thinking down a little bit. When you're not actually trading it via a replay or sort of, replicating that real life situation, you realise how long it does take sometimes to actually come back to areas to give you a trade, or how long it actually takes to break a level. This way it allows you to just step back a little bit, remember that structure, and going into this drill, think about that structure. We spoke about it on the charts. Think about what implications there are there and how this can then start developing some trades, where it can give you opportunities to get in and how you would execute those trades. So there's some key considerations. So drill is have a look at the replay of the December meeting. There will be questions not only on how the market traded, but also the information that you get. So watch the video, the prep video, then take on the video of that December decision. Questions will then follow up.
Quick move down towards 69. So your main target should be 69. The speed of the move down then is your indication to get out. We see much higher volume, delta drops on that move down. That's the flush, that's the stops, that's what you're looking for, and that's the breakdown of that structural completion. As all of those stops get pushed out, that provides you the move and gives you that exit down at 69s. But all of that, it was all about recognizing the move into 95s. To start with, when you drop below 17s, you got the bounce away, and then the second time round, anyone who bought it thinking that they got away with it buying those 95s are just adding to the shorts if you get inside that block. So that first bounce from 95 actually helps you out on the wider trade. It just means that anyone selling below 17s actually gets quite a hard time and can be sitting in a relatively nervous trade waiting for then the larger move to actually play out. But that was the main trade, and it was all about understanding that move into that block that provided you with that opportunity, and that's your structural completion trade. So make sure you're thinking about those situations when you go into any of these central banks, because they can provide often a bigger trade. In this event, we didn't get any new information. We didn't get anything new in the press conference either. The tone didn't really suggest anything, and that's then where you don't just sort of step back and say, oh, okay, we've not got anything from this central bank, there's no opportunities. This is where you can start then leaning on your structure and leaning on other trades that may well come to play, because there is so much more volume. If you look at the volume on the hourly chart, look at those volume histograms, much higher than anything on the prior 4 days. So that extra volume, those extra participants is what creates the movement, and that's what you're looking for these structural completion trades. We'll go on now and we'll have a look further at more technical trades, beginning with a position squeeze. Okay guys, so on to the second technical play that you get over a central bank, and this is a position squeeze trade. Now, the whole premise of this move is that the market is pre-positioned, either pre-positioned for a technical play or pre-positioned in the expectation of the central bank doing something, of acting in a certain way. So you've got two different types of squeeze here. First up, you have technical plays. So people have got themselves into a position, perhaps, for example, trying to play the breakout of a wedge. Now, the idea here is that you've now got people, say, short at the bottom of a wedge, looking for that move to go down. What that then means, and this is similar to the play that you got in the euro that we discussed over the ECB. What that then means is you've got a lot of people who are in a position with quite tight stops, essentially not wanting to take too much risk on this trade. What can then happen is you get a stop out of those positions, there's your squeeze, and then the move continues in the way that it was going to go. So that's your first way of looking at it. The flip side of that is, rather than people having positions for a technical play, a sort of technical breakout type move, is more where you've got a directional move into the event, into the central bank decision. And then what happens is it's not so much a squeeze of the positions going into it. So say, for example, you get a move up on a play for a certain central bank decision. What that's showing you is that people are positioned now long going into this. What would you do if you were long going into a decision? Well, on that decision, if you get the decision that you're expecting, there's your chance to get out of the trade. So you're using the liquidity of the new buyers that come in on the release of that decision to get yourself out. What this then serves to do is create a spike in the direction of the original move, and it's the new positions that enter on the perceived new information from the central bank, which ultimately it is confirmation of new information, confirmation of that decision, those new positions that jump in then get squeezed in the opposite direction as the traders who already have their positions use those new entrants as liquidity to exit their existing positions, and it's then the new entrants that get squeezed in the opposite direction. So what we'll have a look at is I've got two different examples here, both over the Bank of England, and one example of positioning going into it, whereby that positioning is then the move plays into that positioning trade, and you then get the squeeze in the opposite direction. And then the alternative, where you have a technical setup positioning for that technical play that is then squeezed in the opposite direction before that move completes in the same way. Now, considerations for these type of trades. In your planning of any of this, or a trade like this, and you can plan for a trade like this, in your planning for it, what you need to be thinking about is, where are those positions going to exit? So the positioning of the market, what are those people going to do? So put yourself in their head. What would you do if you had that position? So where would those people get out? And also, in doing that, you're answering the question of where could that squeeze reach? So, for example, you may have short positioning and a level a fair bit higher up, commensurate with a standard sort of central bank type move. So if you're looking in the pound, for example, something between 60 and 100 ticks higher perhaps, you could be looking there and thinking, okay, well, maybe that's where the squeeze could go. The stops could get dragged out up to that point, and then we can turn around. Now, that's giving you a little bit of scope, a little bit of an idea of where you might want to try and execute a trade. The next step is, how do you execute that? And you've got one of two options here. First up, and this is more a case where you have a technical type positioning, is a fade. The idea of the fade is if you get a rush against that technical positioning, that's going to jump to a certain point and give you the opportunity to go straight against that move. There's your first trade then, and so that's a very quick, as we've talked about before, quick jump up, sell into the move as it goes up. The important thing here is that you don't get anything from the central bank that is overtly out of line. So you don't really want a binary trade situation. If you have a very binary type trade situation, that could completely change the dynamic of the market. So that's your first opportunity. The alternative to this, and the perhaps slightly safer route, is to go for the reversal trade. So once the squeeze has happened, you're then using that information, that inability of the market to keep a move going in one direction, as your reason to play the reversal. You've got a couple of different options here. First idea is going to be a move back through the scene of the crime, so back through the point where the move began. And that's quite a common trade to see over a central bank, where people jump on the first piece of information, and then as more information comes out, the interpretation changes, and that takes the market back through the scene of the crime, back through the point where the initial move began. That's your first reversal idea. The alternative to that is waiting for an access point to develop. You're not going to know exactly where that point's going to be, and so pre-planning that isn't really something you can do. But what you can be thinking is that if you get that squeeze type move, there is going to become a point that allows you into that trade. I'll try and talk that one through when we go and have a look at the technical squeeze and reversal in the coming slides. So let's go and have a look at the first example of this, and this is a move over the Bank of England, where you have had the market position itself into the decision. So let's go and have a quick look at that. First up, we're going to have a look at a situation where the market has positioned itself into the event. So what you can see here in the pound is that we've had quite a rally going into the Bank of England decision. Past 3 days, and including the morning of the decision, the market has rallied. We've moved up from around about the 139.40s all the way up to around about 142.30, so around 300 ticks of upside activity. What this is suggesting to you is that people are playing for this move. They're getting themselves into long positions in the expectation that the Bank of England is going to suggest that potentially rates could still rise in May, and give some kind of indication as to how that's going to happen, potentially vote in accordance to that as well. So we're getting a movement into this. The other thing to take from the technical player here is that going into it, looking at the profiles, and what you can see here, you can see the profile of the move itself, which is the profile furthest to the right. The profile to the left in the middle of the profile chart is an indication that the market is becoming stretched. We've seen a close that is a long, long way higher, the close indicated by the red asterisks. This is much higher than where value was the previous day, which is down at 141, 42, 44 area. So the market's now getting a little bit stretched. Think about what that means for those who are in positions. If you're long, and perhaps you've been long for a couple of days, yes, the market's becoming stretched, but ultimately you're still on side. You're playing for the Bank of England to give a more hawkish decision. Now, what are people going to do when that happens? What's going to happen is, as the move jumps, as people buy based on the hawkish decision from the Bank of England, those who are already long are going to use this as an opportunity to sell, to exit their positions. And this is where the squeeze comes. The squeeze comes on those who buy on the decision. They buy on the decision, create the spike up, and then they get squeezed in the opposite direction as the market starts to come back. So let's go and have a look at the expectation. Expectation is 9-0 for unchanged rates, but still potentially an indication that they could hike in May. So 9-0 for an unchanged of rates. We've got highs all accumulated around about the 142, 22s to 27s. So that's going to be your area that if you get any jump above there, you're expecting people to start taking profit. The result is that you get 7-2 vote for a hike. So 2 people voting for a hike. However, the interpretation side of this trade is that they add the information that data is broadly consistent with February. So whilst 2 people are voting for a hike, currently data hasn't changed, and so therefore there is no reason to believe that they are likely to hike rates anytime soon. It is just a couple of members. So what you can be thinking here is those who have played long into this are likely to get out. Those who have just bought it on the 7-2 are now in a sticky situation, and this dynamic can add to the selling, giving you a target initially of back down towards 142.04, the previous day's high, and then back onto the top of value, which comes in at 141.44 to 46, which is also a previous high from a few days prior. So you've got targets. The hard part of this trade then is how to enter the trade, and we'll go and have a look at this on a 1 minute in a moment to see where exactly you could have got into this trade and how you could have executed the trade, as well as what to expect when you get in, because that's the other really important part, and particularly important when you're debriefing these types of moves. How exactly does that move play out? What are you looking for when you enter that trade? That way you're managing your expectations going forward. If you expect a move to take half an hour to play out because it's a passive continuation on a reversal, then you're able to sit with it. But if you get into a move expecting an instant reaction and a very quick move that puts you on side, you're going to struggle to hold on when it takes its time to actually play that move out. So that's the important thing to take from this. We'll go now and have a look at it on a 1 minute, have a look at where those opportunities were and how you could have played this trade. Okay, so here is the reaction that we got. The first jump up, we moved from 142.10 up towards around 142.70. There's your spike up. That's the reaction to the 7-2. That takes you through the recent highs at 142.22, 27 area. And that's where people are then rushing to buy. Those who are already long are going to use this as an opportunity to exit, to take their 300 plus tick winner. And that provides some selling pressure. The next element of selling pressure comes from that aforementioned piece that data is unchanged since February. So now you've seen the squeeze, you're starting to see the squeeze. People have entered and the market's starting to come back on them. Now what you've got to do is try and find your entry point. First opportunity here, and we tried to break this down into 3 opportunities. The first trade is a fade. As it jumps up, you can fade it on that very fast move. Now the difficulty with this is we don't have a great deal of reference point. There's no clear level that you can say that would be a good point to fade from. So that makes it quite a tricky trade. Your next step is then actually planning out an access point. How do you get into the next leg of the trade? Now what you can see is that the market falls back and starts to hold above the morning's highs. The morning's highs right around that level, 142.27. So we begin to hold that. And what you're looking for here is then a change in price action. You're looking for a little bit more pace to be coming into the market, more volume getting put through. And that gives you the opportunity then to play a breakout or a breakdown trade back through the morning's highs. And what you're looking for then is a relatively quick move down towards the previous day's high, which comes in at 142.04. This plays out rather swiftly and actually plays out in about 3 minutes. So there's your quick first move, but still remember, we've now spiked to the upside. We've still got people who will be positioned thinking that you're going to get then a pullback and a progression further up. So we've still not seen all that positioning coming out. Remember, this is also a market that has traded up into this move. So you've got a lot of positioning long that are all going to have stops lower and lower down as the move starts to pull back. So your second trade then is to be looking for a passive entry. Previous highs, remember, were 142.22. So you get a pullback up there, and as long as we're not getting back above those previous highs, that's where you have an opportunity for a passive entry to sell as the market rises back up, with the intention then of running this right the way down towards the previous day's value area high and those previous highs at 141.46. That's your bigger target. Now the important thing to be thinking about here, or to be taken from this, is that this second wave trade is a trade that's going to take much longer to play out, and in fact takes around about 2 hours to actually achieve the move. The move's a full 80 ticks to the downside, but it takes 2 hours to do it. And this is something you need to have in your mind when you're taking these trades on. That yes, you can see the entry point, yes, you can see the target, but what often happens is then the middle part goes out of people's heads, and all they focus on is the idea that I'm in here and it's going to go here, and they view it as a straight line move. Now, it's a second wave trade. So this is going to have, the market's going to have slowed down. You can see that volume's fallen off by this point. So you're going to get a much steadier fall from here, a much steadier drift down that's going to take that little bit longer. Now, if you've planned for this and you're ready for it, then that makes an absolutely fine trade, because you're able to then hold on to it. And your particular point of confirmation is when it breaks the lows at 141.90s. They were the lows that we'd established on the back of the initial pullback before the bounce up to give you that passive entry. So once that breaks, then you're confident that the trade is on. That's where your confidence increases, and that's where you can say to yourself, this is going to work. Maintain your stop above the previous day's high, above 142.04, and then you can start targeting that larger move down. So that's how you'd be looking to try and play this. 2 opportunities predominantly: the breakout to the downside for that initial reversal trade, followed by then the passive entry for the much steadier continuation move. You can play this as a combination, that you get in on the first trade, cover some and then add in for the second, or this can be played as two distinctly separate trades. One, the first squeeze of those initial buyers that buy at above 22, and then secondly, as a passive move for this steady continuation to complete the move all the way down towards 140, 146. So two different ways of playing that same idea. It's all about recognizing that people will have given up on their long positions as you get the spike up, use that liquidity to get out, and it's the new buyers who enter at the top of a range that are the ones that get trapped and they get squeezed back the other way. We'll now go and have a look at a technical reversal or a technical squeeze of positions followed by the continuation. So both reversal type plays. We'll go and have a look at that. This provides a little bit more of a clear fade point, a clear sort of reference point where you could fade this, and you'll see the difference in the nature of the market going into the event. So we'll go and have a look at that. This time, the Bank of England once again, but in August in 2018, a few months after this decision had been made. Here we're going to look at a technical reversal. So a reversal of people who are positioned for a technical trade as opposed to positioned in the expectation of a certain event from the Bank of England. So in this situation, you can see the very clear difference. No trend move into this, no directional play into this. The market has been sitting for a couple of weeks between 131 and 132. It's also developed into a wedge, which we're beginning to get towards the end of. And this is where the technical play first comes in. From the morning's trade, and you can see the entirety of the move here, but the morning's trade gives an opportunity to play the break of the wedge, which also coincides with an inside day. The previous day was an inside day, so as that inside day breaks below 131.19 and breaks the wedge at the same price, you've then got an opportunity for a short. Excluding the Bank of England from this is a trade that you would be looking to take. Good technical setup, provides reasonably tight risk reward that you're playing a breakout below the inside day through the wedge and looking then for a move into the consolidation that you can see on the left hand side of the chart, and particularly down to where the majority of the volume is in the 130, 60 to 50 range. So that's going to be your main target on this. Now what's happened so far in the morning coming into this decision is there has been a move out of the wedge that has tested down to 130.90. This is where positions are getting accumulated. People are trying to play for this larger move, getting themselves short below the wedge in that range between 19s and 90s, looking for the continuation and potentially for the Bank of England decision to help with that continuation. Now put yourself in those people's shoes. If you were short on the break of the wedge, on the break of the inside day, where would your stop be? Well, for most of these people, or for many of them, their stops are going to be back inside the wedge, back inside the inside day. And this gives you the clue of a potential squeeze of positions. That anything that turns back up inside this wedge, all of those shorts who played for that continuation, that breakout below the wedge, below the inside day, are likely to come out. And remember, you get lower liquidity over these central bank decisions, so that's potentially going to create a larger move to the upside as well. The added benefit here from a technical point of view as well is that you've got a reference point for this squeeze. You're likely to get people wanting to sell the top of that wedge, wanting to sell that downtrend. So a move back up towards 131.73 could well be your opportunity to fade, to sell any fast spike up for the move lower, assuming that you don't get anything overtly hawkish, for example, a rate hike or a very, very strong vote for, not a very strong vote for a hike, a strong vote for a hike and an indication that we would get further hikes in the future. So, in terms of expectation, what we're looking for here is a 7-2 vote for a hike and the suggestion that you're going to get 3 hikes over the next 3 years. So we're expecting a rate hike, and we're expecting 3 hikes to be indicated over the next 3 years. Now what you in fact get is you get a result of a 9-0. So no dissenters to this rate hike. Everyone votes for the hike. And this is what then squeezes those short positions out. The initial reaction is this is hawkish, squeezes the short positions out, gets the spike to the top of the range, and then reverses. Another interpretation element, much like the previous, is that they suggested that it would be 1.5 hikes over 3 years rather than 2, and that Brexit risks are still prevalent. And so therefore, the indication that hikes are going to be ongoing and perhaps more aggressive than people thought is no longer there. That's very important, and that's what turns the market back down. Once again, we'll go and have a look at this on a 1-minute chart in terms of picking out where you could enter these trades, where those opportunities were. What we'll then do is contrast this with how it actually trades on a ladder, because it's very easy to pick trades out from a chart. And this is where that debriefing element is so important. Looking back at how exactly it did trade, could you have got into any of these opportunities? So we'll have a look at it first from the point of view of where seemingly you could have entered trades. And then we'll go and have a look at it from a ladder point of view as to how exactly you may well have been able to execute those trades. So let's go and have a look at that short-term chart. Okay, so here what we've got is the 1-minute chart as well as the screen dump, the release of that information. And you see the 9-0 is the first thing to come out at the bottom. Remember, you read from the bottom upwards. And then you get a little bit higher up, the reference to the market rate path flatter than in May implies bank rate of 1.1 in 3 years' time. That doesn't suggest 3 hikes over 3 years, because we're already now at 0.75, so it suggests only 1.5 hikes. So that's where you get this fade opportunity from. Now, looking at a chart, your first thought is, well, you have the fade from the top of the range, up at those 73s. So that's your first trade. Jumps up on the 9-0, and there's your fade. What you then have to do, and we'll see this on a ladder, is the actual trade opportunity there comes more in this fast recognition of a range establishing between 131.50s to 20s. And we'll see that range then trade up and down, up and down. Next up, you're then looking for a breakout trade. And with a lot of these types of trades, it can take some time before you actually get the opportunity to take the trade on. And this is what I mean about trying to find your access point. It's not always going to be crystal clear where you can get into this trade. You can't plan beforehand where exactly you would want to get in. What you do know is there are some very key reference points. 131.10, for example, was the previous lows and the point where people were looking for this breakdown on that inside day and the wedge break. We'd also established lows at 90s for the day. So a break of 90s then accelerates this idea of falling. It also means that anyone who has bought it on the decision is definitely wrong. No one could have bought it on the decision and still been on side when you get through the low of the day. So what you're starting to look for then, and this comes into trade 2, the breakout element, is clues for this. And what you see is we have around about 45 minutes of sideways trade. But you get a very good clue that once we've established this range between 20s and 50s, is you then start to get quite this heavy sell-off. Comes a few minutes after the decision. Heavy selling back down once again towards 131.10. So we're seeing that the sellers are willing to take control here. Don't get any movement back up, and so the 131.10 then becomes your access point. We've tested it. By the time the breakout comes, that's been tested twice. You're looking then for your entry as it breaks through there. And as it breaks through, potentially a pullback and a stall there to give you a passive continuation trade. So that's your third opportunity that you play in the passive trade as you break 10 to get in, still with the intention this is going to fall through 90 and then continue down towards that 130, 60 to 50 range. In terms of your exit, what you're looking here for is any exhaustion into that zone. So rather than putting a definitive this is the level on it, use the price action to show you where that level could be. So as you get this exhaustion move down, this fast drop into 60s, that's your clue. That's the place to be getting out of your trade, and that gives you opportunity to exit. If you want to hold on further, you can do, and we'll see that from the price action from the ladder, where exactly you could have held on to this trade, and some of the clues that you should be looking for, and some of the things that you'd be putting into your debrief as to how exactly this traded to learn from in the future. What I've done here is, if you look at it purely from a chart point of view, there seems to be some very easy and very obvious trades to take here. We'll see on a ladder how particularly the fade at the top of that range was a very, very difficult trade to actually execute. So let's go and have a look at that, and we'll go and have a look at how this was actually traded. Okay guys, take note of where the pound first starts. The video will stop in a moment and you'll see the initial spike on the very first release, instant up towards 75, giving you very little chance of getting in. Now what you can see there, and as the box showed, it was instant to 75 and straight back to 40. This meant that the only way you could possibly fade this was by having an offer there. So your next area of fade is to establish where the market's ranging. We've seen a trade up towards 50 and we can't then get beyond there. What typically happens after the first spike is we get a bit of trade that creates a small range. There again, once up more, up towards 50s, and we find resistance. So this range is now being established. 131.20s up to 50s. Remember, 131.19 was the breakout point. That was your inside day break. So we're staying just inside there, holding above 20s, trading up to 50. So if you're looking to play the long trade here, the continuation to keep the move going towards new highs, you have that opportunity. You'll be playing this trade as long as we're staying above 20s. You're looking then for a break of 50s and a continuation higher. But what we start to see here, we're just over a minute after the event. Volumes have started to fade a little bit. We started to slow down. Once again, another push up to 50. Do we see any continuation? No. So what we've now got is a range that we're waiting to see the break of. Now, from a technical point of view, those shorts could well now have been viewed as being squeezed out, and we're then going to get new shorts established on a break back below 19s and 10s. So that's going to be your idea. If you are sticking to this technical view that we have a position squeeze up based on the technical wedge break, that position squeeze up, then we're looking for more selling as we come back below 19s and 10s. Whilst above there though, whilst inside the inside days range, we've still got scope to the upside. And also based on the slightly more hawkish decision from the Bank of England, we've still got scope there. So there we go, down towards 20s, and we're starting now to actually just have a little bit of a tip through 19s, 20s. Find support again. You now need the support to act and start giving us buyers, bringing the market back up through the 25s where the average price is, back up towards the 50s once more. But what you now start to see here, it's struggled at 25. We've had another attempt at selling here. This could be your first attempt at the breakout trade to the downside through the 19s. If we can get through 10s, then you should get the acceleration. So here's the first push down towards 12s, 13s, and we find some buying quickly. Now the important thing here, if you're going for the short, is that we don't break 19s. If we get back above 19s, then your reason for the short is no longer valid. And also the more important element is you're looking for it to move back through 10s. We're not seeing that. We're now starting to tick back up above 19, and so we can now start looking for a move, particularly if we get through 25s, all the way back up towards the 30s to 50s area.
So the first attempt is not there. That first attempt lower has failed at 19. We're now starting to tick back up through the range. And still a potential opportunity. Those who are long are still feeling they've got a little bit of comfort in this trade. They're still slightly safe on this, and we can still be looking for a further continuation up towards 50s and then potentially all the way up towards the new high. So we're back into that range and back consolidating once more. This is giving us a little clue. We're starting to establish a low that's important down at 12s, which also coincides with those previous lows where the main part of the breakout is likely to come from. So that's what we've managed to establish so far. Remember, these trades often can take a little bit of time before we get the next leg of the move, and so you get 45 minutes now before the next leg. The next video will show the final leg